Hello and welcome to Econoday Unplugged on Wednesday, the 2nd of February 2022. This week sees our monthly global roundup. So on the podcast today, we have Terry Sheehan stateside, Max Sato's in British Columbia, Brian Jackson's in Sydney, and I'm Jeremy Hawkins in London. Well, it still seems to be inflation, Russia and COVID pulling most of the strings in financial markets in general. But of course, policy responses around the world have to respect what's going on locally, and national economic conditions differ markedly. So while the Fed, the Bank of Canada, and for a second successive meeting, the Bank of England all look likely to be hiking interest rates soon, other central banks, such as the Bank of Japan, European Central Bank, and Reserve Bank of Australia, seem to be in no hurry to follow suit. To find out why, let's have a trip around our regional experts to see just how far out of sync the various economies are. So then, Terry, let's kick off with you. Big news last week, of course, was the FOMC meeting. Now, if I can just quickly quote from Fed Chair Jay Powell. So, the economy is now much stronger. The labour market is far stronger. Inflation is running well above our 2% target, much higher than it was, referring to the 2015 when they last started tightening. And these differences are likely to have important implications for the appropriate pace of policy adjustments. So just how hawkish do you think the Fed has become? And indeed, do you think the economy justifies it?
Well, I think the hawkishness of the Fed has greatly increased. We even recently heard Atlanta Fed President Raphael Bostic talking about a 50 basis point increase for the possible future. And the fourth quarter finished very strong with nearly 7% growth here in the US. So all that would seem to say that the US economy can support some tightening in monetary policy. On the other hand, we've gotten some early January data for the manufacturing and service sectors. It does look like things are slowing down. And then this morning we got a report from ADP suggesting that private payrolls could drop well over 300,000 in January. So we may see a Fed that's leaning hawkish, but they are definitely going to be paying attention to the data.
Well, I was going to ask you about the payroll. I haven't seen that. So a decline of 300,000 in private payrolls in January.
Yes.
I know January is always a wacko number anyway because the seasonal factors are so big. But were we to get that, do you think that would have any implications at all for, well, what everyone is assuming to be a March tightening?
It would have some implications, but I think it would have to look at it as a 1 month piece of data and wait until February and see if that kind of slowing was sustained.
Okay, fair enough. Let me ask about fourth quarter GDP, because you mentioned almost 7% growth annualized, which, let's be honest, is a pretty chunky number. But as I recall, a big chunk of that actually came out of business inventories. So is that something which might hit growth later on, or was that part of producers building inventory because they think demand's going to be very strong, do you think?
I think part of it is they're doing a lot of restocking because inventories have been very lean. The other thing that I think was going on is where they could invest in things in advance of higher interest rates, they were doing that, especially if it was something they'd have to finance. So I do think that was probably more in reaction to being able to get some goods to stock up on and making sure that anything that was going to be costly to buy, they finance now.
Okay, I mean, the Omicron effect, which we've certainly seen in Europe now, and certainly be asking Max and Brian about that in their parts of the world as well. Is it having much of an impact? I mean, this 300,000 drop, possible drop in payrolls, is that going to be heavily Omicron related, or where's it coming from?
If I looked at the details of the data, it seems to be concentrated in leisure and hospitality and trade and transportation. Mm-hmm. These are two areas that typically lay off heavily after the holiday period. So it's possible that some of it is just the end of temporary employment for the holiday shopping period. But I think it may also be due to some severe weather incidents, things like airlines canceling a lot of flights, so people were getting laid off as a result. So it's a bit of a mess, and it is Omicron related.
Right. Okay. And Marcel, how are the Omicron numbers doing on your side now? Are they
Uh,
still rising? Are they coming down yet, or?
they're starting to come down. It's still pretty widespread, but there are signs that this current wave at least has peaked.
Okay, and if I want to ask you about just going back to the Fed and well, I guess the balance sheet. I think Powell was suggesting that the Fed is willing to move sooner than they did last time, and also talking about the fact that the balance sheet is a lot bigger than it was when last time they started trying to move out of quantitative easing. So, we got any sort of sense of how they're going to address the fact that the balance sheet is far too big and what they're going to do to reduce it?
No, they're playing that one pretty close to the vest. Powell has been saying that they discussed it at the last two meetings. They'll be discussing it further at upcoming meetings. I think we'll probably get a better indication of just what they plan after March if we get the interest rate hike then, which we expect.
Okay, and I guess there's no real sense on how far they actually want to, to pare down the balance sheet. There's no kind of idea of what sort of percentage of GDP or an outright number or whatever sort of metric you want to use.
No, I think their biggest thing is they want to avoid any market disruptions in the process.
Yeah, perfectly understandable. Okay, well, that's my questions for you. Anything else you'd like to lob into the pot?
No, I think the main thing right now is we're waiting for the government's employment report on Friday, because that's going to be a big question mark after the private numbers this morning.
Okay, excellent. Thanks for that, Terry. Right, let's move across north of the border then. Max, where are we on Canada? We had a decent number for November GDP. The economy seems to be, back above its pre-COVID level in terms of total output. So what are the odds now on the Bank of Canada increasing interest rates at the next meeting?
I think it was very clear that Governor Macklem, judging from his post-decision presser, that the interest rate is going to go up. He said we're on a rising path, and he said we signaled very clearly to the Canadians that they should expect a path toward high interest rates. And but then he was also saying they're keeping in mind that there is this lingering negative impact of pandemic on the economy. Some people cannot report to work because they have to stay at home when they test positive. So they're being careful, but it's clear that they're going on March 2nd, the next meeting. No, sorry, not meeting, but policy announcement.
So they're definitely. Do you think they're definitely going to raise
expectations here? The bank's going to continue raising rates maybe 2 or 3 times throughout the year at least to try to raise the interest rate more neutral to the economy. But that all depends on the data, obviously.
Right. Okay. And what about also, as I was asking Terry about, have they said any much about what they plan to do in terms of, ultimately quantitative tightening, but at least what they're going to do with the balance sheet in the near term?
According to the latest statement, it will keep its holdings of the Bank of Canada bonds on its balance sheet, but without saying until when. And then the Governing Council will consider what to do at the time. And so I think the first thing we're going to see is maybe 25 basis point rate hike.
So rates go up certainly before they start doing anything with the balance sheet then?
I think that's what they're trying to say.
Okay, great. Can I also ask you, over the year, there's been some coverage of this truckers dispute taking place in Canada. I mean, is it large enough to actually have any impact on the economic numbers?
It is surely dividing the nation. And if you talk to people living in Ottawa, the noise pollution is so much, and some disgraceful behavior by the demonstrators are there. But according to the reports, they don't represent the majority of the truckers who are actually vaccinated. So it's becoming a political statement, and I'm not sure if this is going to disrupt the logistics. We have seen the worst impact from major flooding in BC, and that actually cut off the distribution from the port and onward between the east and west of the country. But I don't see any disturbing numbers or suggestions, anecdotal evidence from the protests.
Okay, fair enough. Anything else you'd like to add on the Canadian situation?
I could say the rate of increase in COVID cases is decreasing, but I'm not sure if it's we're ready to say the worst is over.
Okay, fair enough. Thanks for that, Max. Right, well, let's start heading down towards some of the southern climes. Brian, I guess we should kick off with China, really, since there's still a lot of focus on that. I don't know, there still seems to be a lot of speculation about just how weak the Chinese economy is, particularly after the latest round of interest rate cuts. So kind of what's your sense of what's going on?
Yeah, well, I think, this is a story that we've seen for 4 or 5 months now. Just the numbers are continuing to come, rather disappointing and showing subdued growth across most sectors of the economy. And I think it's the same sort of factors that we have been talking about for a while. Some of the measures that they've taken to curb energy consumption in 2021, but also probably the main factor is just the zero COVID approach that authorities are still taking pretty aggressively whenever there are outbreaks in parts of the country.
Is that, sorry to interrupt, is that still nailed on? I mean, this zero COVID, is there any chance that they might actually relax that a little bit, or is it just a done deal?
Well, I mean, we haven't seen any indications yet. I mean, we're always hoping that the pandemic will take a turn for the better, and we'll be able to move past some of the really tight restrictions that still are in place. But yeah, it's not looking like it's happening anytime soon, and so that's just going to continue to be a bit of a drag on most parts of the economy, and that's why contrary to sort of other parts of the world, we still see policymakers, in fact, moving slowly towards easier policy in very incremental steps, but still no sign that they're thinking that they need to turn towards tighter policy. Now, of course, also the other factor that we need to take into consideration for China is that we're sort of entering into the blind spot that we see every year for the data because of the Lunar New Year holidays. So we're not going to get data for January over the next few weeks in February, because what they do is they combine the data for January and February together and release it in sort of mid-March. So for the next month or so, we're not going to have that sort of updated information about actually how the economy is tracking until we get the combined numbers in mid-March.
Okay, but can I ask you, is there any sense about, well, what kind of impact, if any, the Winter Olympics might have?
It's not really a big focus, I think. I don't, obviously it'll have a bit of an impact in some parts of the country and in some sectors, but I don't think it'll be really enough to move the needle on an aggregate scale. It's it's a big sort of sporting event, but I don't think it's going to have a huge impact on a lot of the numbers that are coming out of China, and it's definitely, I don't think, going to be enough to offset this zero COVID approach that they're taking.
Right. Okay, fair enough. Right, let's pop across to your part, well, immediate part of the world, and then Australia. And I guess what can you say about the Reserve Bank of Australia? Well, I mean, it's repeatedly insisted that any kind of hike in domestic interest rates isn't going to come until 2023. We've just had their latest statement. I mean, is that still the case?
Yeah, they're still pushing pretty hard against the idea that they might have to raise rates, sometime soon. Obviously, last month we had the inflation numbers come out for the December quarter, and that showed that headline inflation has now been at or above 3% for 3 quarters in a row. So the RBA has the target range of 2 to 3%, and headline inflation has been above that target range for nearly a year now. And we've also seen underlying inflation sort of move up into the middle part of that target range, around 2.5%. So
what's haven't they been saying that it's got to be sort of sustainably above it? So
yeah,
what
so that's
counts
the key,
as sustainable?
That's the key phrase. That they won't increase policy rates until inflation is sustainably in that target. But this definition of what is meant by sustainably, well, we had the governor of the RBA, Dr. Philip Lau, come out yesterday, and he said, look, we don't really have a specific definition of what that means. It's kind of like, you'll know it when you see it, sort of thing. So that just means that it gives them a little bit of I guess wiggle room to decide when inflation is at a level where they can start to hike rates. So he's basically just saying that it's still not completely certain about when they will move. So a lot of the markets are pushing this idea that they're pricing in a rate hike later this year. And he was forced to concede in sort of the question and answer session of his speech yesterday that a rate hike this year is plausible. That's the phrase he used. But he still seems to be pushing against the idea that they'll have to be pretty aggressive and move quickly. He said basically, look, inflation's gone up, but it's still a lot lower here in Australia than it is in other parts of the world. So we don't have to move rates as quickly or as aggressively as other central banks.
Okay, fair enough. What about the balance sheet? So they're ending, if I remember rightly, they're ending now quantitative easing middle of this month. Is that right? What do they plan to do with it? Are they going to reinvest maturing bonds? Are they keep it flat, or are they going to actually start thinking about outright sales?
They haven't committed to anything at the moment, but they're just they've been scaling back those purchases for a couple of months now, and as you say, they're going to cease the purchases next week. And again, we had the RBA saying, well, look, that doesn't actually represent a tightening of monetary policy, because it's not so much about the flow of purchases, but the stock of existing purchases that will provide that ongoing support. So they still seem to think that the economy could do with some policy support, but they just don't need to keep on buying assets. That the existing stock of purchases will continue to provide support.
Right. Martin, it's quite interesting to look at some of the different views from the different central banks as to whether it's the stock of quantitative easing which actually determines the stance, or whether or not it's the actual flow and so on. There certainly appears to be different views amongst central banks who go around the world. All right. New Zealand, got to ask you about that, because I assume it's still the case, given the latest figures we've had out of New Zealand, that interest rate expectations are that they'll be going up again later on this month.
Yeah, they've gone. So they've hiked twice, and for the last two policy meetings, and every indication is that they think that there's still more to come. Whether or not they'll go every single meeting is to be determined. But that's clearly the policy bias at the moment. And so we're seeing a real sort of divergence across the region. As I said before, China is still tweaking policy to be a bit looser. Australia and India, I think you could say, are sort of trying to hold the line at the moment. But you've also got parts of the region where central banks are raising rates. So South Korea's gone 3 times, and New Zealand twice in the last few months.
Okay, is there any idea how high New Zealand rates might go?
I mean, I think they'll try and get back to some sort of level of normality. They're still historically very low at 0.75%. Before the pandemic, it was up around 1%, 1.5%. So I think if they can try and get back to sort of around that 1.5% level that was prevailing before the pandemic, that could be at least a medium-term goal, just to try and get back to a sort of normal level, and not have the emergency levels that we've seen over the last couple of years.
Okay, fair enough. And perhaps just as an aside, really, from my side, but just out of interest, there's been some sort of reports on Hong Kong, which we don't always talk about some of the problems they're having now because of these stringent COVID-19 policies, and talking about, I don't know, an exodus of foreign firms and sort of staff, which actually jeopardize its position as a financial hub. Is that appear to be a genuine concern out there, or is it just something overseas investors are looking at, and it's just kind of their view of things?
Well, it could be a little bit of both. Obviously people are looking at that, and yeah, I've seen some of those reports too. And I used to live in Hong Kong and still know some people in Hong Kong, and yeah, it's not the same place it was 10 years ago in terms of being a destination that's quite attractive for expats and in particular fields of industry. So it's definitely a concern. I'm sure it's not the number one priority for policymakers at the top levels of the Hong Kong and Chinese government. What the impact is on expats and that some parts of the financial sector, they sort of obviously have other priorities in mind. But it's definitely one of the factors that have contributed to Hong Kong's success for a long time.
Right.
Its status as a sort of financial hub in the region, and this does cause this does raise concerns that whether they will be able to continue.
Okay, and just quickly, how is Hong Kong economy doing now? Because I know in previous when we've been on podcasts, certainly last year anyway, well, some fairly dire numbers coming out of Hong Kong. Are we in kind of a recovery phase yet?
I wouldn't say recovery. It's more just stabilisation. So we're no longer seeing the big free fall in numbers that we saw. If you look at the PMI numbers in the early days of the pandemic, but it's hardly a strong recovery as well. It's just sort of bouncing around, pretty flat. And I think that's going to be the case until we do see a relaxation of the restrictions. They're very tight in Hong Kong about trying to get on top of this, and it's having a real economic impact, but not as bad as in the initial stages of the pandemic.
Okay, that's great. Anything else from you, Brian?
No, I mean we're obviously like much of the world, just looking at the domestic cases and seeing if we can get over this recent surge and then get back to normal. Obviously, a lot of policymakers think that once we do see a stabilisation in domestic cases, then conditions will improve quickly, and once that happens, I think you will start to see a greater policy response, but that's still a little bit in the future for some parts of the region.
Okay. Well, I think that's great. But just one quick question before we move on. Russia, Ukraine, is there clearly, obviously within Europe, it's a major focus at the moment. Is it much of a focal point in your part of the world?
I wouldn't say it's it's on the front page every day, but it's obviously a concern, and it just sort of feeds into sort of broader geopolitical concerns that we've had in recent years about China's relations with many parts of the region and the US. So I think you would just sort of add it into that category of a sort of general geopolitical risk, but it's not the number one issue here at the moment. But obviously, if the situation deteriorates, and we hope obviously that it doesn't, but if it does, then that would quickly get more and more attention. At the moment, it's sort of just a wait and see, and hope that things don't get too bad.
Okay, brilliant. Thanks, Brian. Right, Mr. Sato again, Japan. I'm never really too sure what to ask about Japan because it always seems to be sort of flat lines as far as most of the market's going to go. So what can you tell me about Japan that we didn't know last time you were on?
Okay, so people in Japan are talking about stealth movement. One is on the price front. They say a lot of companies doing stealth price hikes, which is what they call another term is shrinkflation. Whether crisp chips or other snacks or tissue paper boxes, they pack a smaller amount and keeping the prices fairly the same, so the consumers get less. And they're also talking about stealth about the Bank of Japan. I mean, that has already happened. When they reviewed their operations last March, they try to make the asset purchases less dominant in the market so that they don't disturb the price setting. So overall, the Bank of Japan has been going easy on the asset purchases. And they have already announced that they're ending some of the anti-COVID financing measures, mostly for the big companies, but continuing extending by 6 months for the measures for the smaller companies. So they're trying to keep a good balance. But if you ask me if the bank's going to raise rates in the future, I don't think it's possible. Probably the Bank of Japan people wishing that they're seeing 4 or 5% inflation now. They want to see CPI overshoot beyond the 2% target.
Right.
And recently in the January outlook report, they raised the core CPI forecast. Median for the board is 1.1 from 0.9 for the next fiscal year starting in April, and the same for the following year. So when Kuroda is ending his second 5-year term, we still see just about half of what they want to see in terms of the inflation rate. Mm-hmm. But then in the US, obviously the Fed has to fight inflation, and the people are obviously suffering. Companies are suffering. But in Japan, companies may be suffering, but one of the disturbing phenomena there is people whose kids get sick and can't report to work because they have to stay at home. There's a system, new fiscal measure to help to give money to people who lose income, but a lot of companies, the companies have to apply for it, and then they're refusing to do so because they involves obviously a lot of paperwork, and they don't want labor bureau people to investigate their practices. So you may have a notion that the Japanese society is polite, but they're not necessarily kind, and that's the long-term problem. Corporate behavior, people may not be so kind to each other. So that's that can be a underlying problem I can see.
Okay, can I ask you about the COVID numbers out there? Because I think the numbers have really escalated sharply over the course of the last few weeks or so. I mean, Brian was talking about, that the zero COVID policy we have in the likes of China and Hong Kong. What's the Japanese authorities' attitude towards it?
I don't think they know what to do. There's a huge spike they had never seen before, and it's still rising, the total number, and more people being hospitalized, or the municipalities are trying to be preemptive, so they're telling people to stay at home instead of going to a clinic or hospital. So they're being hit by the 6th wave during the pandemic, and booster shots, they just began to give them to teachers and essential workers. And that means while they were ahead of most of Europe and North America in the fall, they are now falling behind. So that means even though the GDP is going to obviously rebound in the October, December quarter, we're going to see on February 15th, but January, March is going to be extremely uncertain.
Yeah, that's true. A lot of countries at the moment, just from what Terry was saying about her part of the world, and it's certainly true in Europe as well. Okay, anything else from your side on Japan, Max?
I think that's about it so far.
Okay, lovely. Thanks a lot for that. In which case, let's round things off on the European side. Of course, we have a highlight of Europe this week, a couple of central bank meetings, the ECB and the Bank of England. ECB then first on Thursday. Well, there's a lot of different directions as far as central banks are going at the moment, but the ECB seems to be amongst that, seemingly minority group now, which doesn't want to do anything with policy, and it's very much sitting on the sidelines as it watches other central banks respond respond to rising inflationary risks. So we know that the Pandemic Emergency Purchase Programme, the key arm of their quantitative easing programme, that's being in the process of being phased out at the moment, and they should reaffirm on Thursday that that will indeed end come the end of March time. It's unlikely to be fully utilised once we get there, but nonetheless, that's when it's going to be terminated. And to offset that loss, we'll see a temporary increase in the other part of quantitative easing, the old long-standing asset purchase programme. That'll be raised in the second quarter and the third quarter to partially offset the loss of the PEP before it reverts back to the current €20 billion a month asset purchase target for the fourth quarter and indeed beyond that. President Lagarde is still saying that there'll be no rate rises or doesn't expect to see any interest rate rises in the Eurozone in 2022. But quite clearly, price pressures are still building. And as far as financial markets are concerned now, they're discounting what at least a couple of hikes as far as this year's concerned. Adding to that speculation, earlier today, we had the Wednesday inflation figures, which I must say really did come as something of a shock. So these are for January, the flash numbers, and they're expected to see a decline just due to technical factors. Essentially, it's just some of the dropping out of various distortions which have been caused by changes to German VAT. This should have taken, perhaps about 0.5 percentage point or so. It's hard to estimate it exactly, but off the headline inflation rate. And certainly the consensus was that we would see a sharp decline in that rate for January. In practice, it actually went up to 5.1% from 5.0%, only a tick, but that's a new record high for the region since the euro was first introduced. It was about 0.8 percentage points above the market consensus, which is a huge gap. And we're now 3.1 percentage points above the ECB's own target. So it kind of suggests how we want to slice this, and there are a lot of bits and pieces going through the data which make them quite hard to really interpret at the moment. But on the basis of what we've got, it really does look as if if we can call it the real headline rate, now that we got these German tax effects having dropped out, is still trending up. The core rate now stands at 2.3%. That at least was down from 2.6% last time, but again, really should have been lower given the impact of the changes to German VAT. So it looks as if inflationary pressure is still continuing to build, which means that when we get to the ECB meeting tomorrow, the splits which we've seen from various minutes of these meetings in the past are going to indicate that the governing council of a disagreement there is getting wider and wider. In terms of the economy, it's not doing too badly. I mean, growth, we've had the flash estimate, the preliminary flash estimate, I should say, for the fourth quarter. That showed a 0.3% quarter-on-quarter rise in total output, about in line with expectations. And to be fair, it looks as if that would have been a good deal stronger, but for, one, Omicron effects, as we've been talking about in the podcast anyway, which very much hit the service side of the economy. And also due to Germany. Germany saw a 0.7% quarterly contraction in GDP, and that really just shows how it's been disproportionately hard hit by the ongoing supply chain problems in its key manufacturing industry. And indeed, just a reflection of how bad Omicron's been in Europe, German retail sales in December, which originally were expected to be a pretty good run-up for the Christmas retail sector, they were down almost 5.5% on the month. Now, it does seem as if the first quarter is going to start off a little bit better, but because the Omicron numbers are still at record levels, they may be starting to peak now. But if they are peaking, they really are very high at the moment. So it's going to hit first quarter growth anyway. But it does look now as if we're going to see some kind of improvement coming through in the first quarter. That said, France and Germany have still got a fair number of restrictions in place, which is going to limit both demand and supply in the two biggest countries in the Eurozone. So don't expect strong first quarter growth out the Eurozone. It ain't going to happen. However, the labour market is doing well. We've got the unemployment rate down now at its lowest level it's been really since the euro actually came together in the first place. So the labour market at least is quite tight. Put it all together, and it almost certainly means there'll be nothing out of the ECB in terms of changes to policy tomorrow, but we will see widening splits in terms of what the various members want to see. And that's going to make it kind of difficult to put together some kind of a consistent and coherent policy statement. And it'll certainly be interesting to see what President Lagarde has to say at a press conference. So as I mentioned so far, her view is very much, yes, I know inflation's high, but don't worry, it's coming down. Well, after these January figures, she may have to perhaps to change her tone a little bit, and that could certainly have some implications for the way Eurozone bond markets work. Out of the UK then, Bank of England on Thursday, well, as nothing's really happened since the last meeting to indicate that we won't see bank rate, the benchmark interest rate, being hiked again over here in London. The economy, by and large, appears to be picking up steam, notwithstanding some of the COVID problems. November GDP, the monthly number, we had up 1.1%, which is well above expectations, and also takes the economy back above its pre-crisis level, which makes it that much easier for the bank to raise rates if they want to. Labour market's been surprisingly strong, and inflation, well, I'll be surprised if we don't see the bank being forced to raise its inflation forecast tomorrow. We'll get a new monetary policy report from them when they include all their updated economic forecasts, etc., etc. They were last time talking about inflation over here peaking at 6% in April. That's when we'll get a review of the price cap we have on domestic energy prices here. That's going to be hiked significantly, I expect, and it seems likely that we could see an inflation rate peak around 7% now rather than the 6% the bank we're expecting. So again, that's in line with another interest rate hike. So it looks as if, by and large, everything's set now for, I suspect, a 25 basis point on bank rate tomorrow, and that will take it up to 0.5%. And that's significant because that is the threshold at which the bank is due to stop reinvesting their maturing quantitative easing bonds. In so doing, of course, that's going to allow the balance sheet to begin to shrink as of then. So although it's going to be a relatively slow process, there is a chunky, about £28 billion worth of bonds due to fall to run off on March the 7th. So we will see the balance sheet shrink quite significant, really, as of that date. Thereafter, it's going to be quite slow, but nonetheless, we can see a combination of both quantitative tightening and the hike in bank rate. So simply that the hike in bank rate itself will not really reflect the amount of tightening taking place over the course of the next month or so. It also seems
and Jeremy, just with the Bank of England, I mean, where do you see them sort of moving policy rates in the near term, sort of back to pre-pandemic levels, or even further?
I think at this stage, you're sort of saying from your side, it's pretty hard to guess where these rates are going to top out, because no one, I don't think, really knows what the, if you like, the new normal or the equilibrium rate is going to be. But I say we stand at, well, we're probably, as of tomorrow, stand at 0.5%. I suspect they want to get up to at least 2%, if not a bit higher than that, if they can do. But really, I think, as and when inflation does peak, I think the chances are we will start to see it coming back down again. And because there's so much uncertainty about the state of the world, what's happened structurally because of all the implications and effects of the coronavirus, I think central bankers and policymakers in general really don't know what kind of, if you like, target level of interest rates they should have. But I think what we can say at the moment, the Bank of England and I think some other central banks, and it'll be interesting, ultimately, see what the likes of the RBA do. But I think the bank has certainly been caught out by the speed with which inflation has accelerated. They weren't looking for anything like these kind of numbers we have at the moment, and it's going to go up higher almost certainly the next month or so. So they are kind of lagging behind the curve, and I think there's a good chance we'll see perhaps 3 interest rate hikes this year, possibly even 4. If we see the wages market start to respond. And that, I think, as we talked about on previous podcasts, the key to where these rates do finally top out is going to come down to what's happening in the labour market. Now, if you look at UK wages, the official data suggests that average earnings growth is slowing. But you've got all these problems of base effects due to changes in the composition of the basket because of the way the labour market is structured now. But if you look at sort of 2-year changes rather than the 1-year changes in wages in the UK, effectively they're trending up, and they're trending up from quite high levels. And that's true of whether you look at headline earnings growth or whether you look at regular earnings growth and you strip out bonuses and such like. So I think long-winded, but the answer to your question is I think they've probably got a reasonable way to go. I don't think we'll get back to the 4% type marks that we all became used to long before the global financial crisis. But I think current rates are really far too low, and central banks are going to be forced to do it by the markets, even if they don't want to do it themselves. Okay, what else I got from my side? That's probably most for UK. I should mention. I suppose I should quickly mention politics over here. I mean, we talked about on the last week's podcast that politics are a right messy business in the UK at the moment. There is still an awful lot of pressure on Boris Johnson, a Prime Minister, to stand down. We're still waiting to see whether or not there's going to be a full leadership challenge. It does seem to be shaping up that way. But it's got to be said, I guess, if you're a prime minister under pressure and you see the pound going up, and you think there's a good chance you might actually lose your job, it doesn't reflect on your ability too well. And I suspect that really is down to the fact that were Boris Johnson to leave, his replacement most likely, I suspect, would be Rishi Sunak, who's the UK Chancellor of the Exchequer, who by and large is pretty well respected in the UK financial market. So if Johnson were to go, it might actually be a plus factor rather than a negative factor for the pound. What shall I round off with? I'll round off quickly with Switzerland. The Swiss National Bank last week reactivated their so-called counter-cyclical capital buffer, a posh name for really just a guide to banks which forces them to acquire reserves, at least keep reserves, due to possible losses on what is currently a red-hot property market. So really they're trying to slow down the rate of growth in property prices. And I guess that's kind of a feature we've seen around most of the world at the moment. I know, Brian, from your sort of side, notably New Zealand, I think they've already introduced additional loan value ratios or something, haven't they, last year, I think, to try and restrict the property market, where prices are going there.
Yeah, and there's also been some suggestion that they'll be needed in Australia to sort of just try and, if the RBA is not going to move them, some other ways of trying to curb the housing market here as well.
Yeah, I guess so. I guess when you're looking for dislocations, we talk about broad economic cycles, but also at a sectoral level, what's going on in the housing market, could really be a major problem for the global economy if prices continue to rise. So anyway, as mentioned, Swiss National Bank looking to try and do something about that. It's just a reflection of what's going on there, due to the fact that, of course, they've got negative interest rates pretty well across the curve. Okay, that I think then is probably it from me. Does anybody else have a link they'd like to say before we wrap it up?
Nothing.
Jeremy, quick question.
Yeah.
Go ahead.
Sorry, who's got the quick question? So quick.
Max here.
Yeah.
So the tensions over Ukraine.
Yeah.
Do we have to watch out for any spillover effects on the markets or real economy in the region or global?
Well, I think yes and yes. I think when you're looking at the bond markets at the moment, there's two very much competing forces here. One, you've got quite clearly an overall investor concern about, look, inflation's going up. What are you going to do about it? You central banks need to start tightening, and that's clearly helping to push yields up. However, on the other hand, you've got, if we actually do see some kind of Russian incursion into Ukraine, then almost certainly there's going to be a flight to quality, and you're going to see an immediate demand for sovereign bonds. So that's going to start dragging yields down. So I think if we go back a little bit before this Ukraine thing really started to, I can't say blow up because blow up's the wrong word in this context, but really started to escalate. Bond yields, 10-year US debt looked to be heading towards 2% with nothing that's going to stop it. Then we had the big escalation of tensions on the border between Russia and Ukraine. We saw yields pull back again. And I think we're still in that kind of world at the moment. But if Russia does invade Ukraine, I think you've got to assume that there will be, at least initially anyway, some lowering of international bond yields. And you're also going to see a flow into the safe haven currencies. So presumably it'll be good for the Japanese yen. It'll certainly be good for the US dollar, which I expect will probably come best out of it. Within Europe, it'll be good for the likes of a Swiss franc. And it may also be slightly beneficial for the pound as well. I mean, the issue for Europe is that for the European Union, around about 40% of their energy supplies come out of Russia. For the likes of the UK, off the top of my head, it's around about 6%, 7%, something like that. So it's not such a big issue for the likes of the UK. So it may well mean that the likes of UK markets would outperform what's happening elsewhere in Europe. But yes, I think worst case would be we're going to see what happens to ultimately energy prices. If Russia starts turning the tap off for Europe, crude oil prices, crude gas prices in Europe are going to go through the roof. And the inflation is going to go up a lot higher. So I think most definitely what's happening Russia-Ukraine at the moment needs to be watching, because it's going to have implications not just for Europe, but for the way the global economy works in general. Right. On that happy note, and of course, as Brian was saying, let's hope that nothing actually happens in that part of the world anyway. Right. So that is it for this week then. I guess putting Russia on one side, it still seems to be that an increasing worry for investors now is that some central banks are falling behind the curve. If that is the case, we'll notice perhaps one way of addressing it is to go down the Turkish route. And last week we saw the Turkish President Erdogan sack his head of the National Statistical Institute for apparently releasing inflation data that the president thought were too high. After all, it's only a number anyway, isn't it? Right, well, for coverage of key economic data and events that you know you can trust, be sure to keep up to date with Econoday's global economic calendar. On behalf of Terry, Max, Brian and myself, thanks as always for listening. We hope you can tune in again next week. Bye for now. Strategic investing and analysis are a lot easier when you can identify patterns and see how economic events and announcements correlate with specific market movements. The Econoday Investors Journal provides a convenient and easy way to follow important economic events every day, every month throughout the year. View the most important market-moving events for the upcoming year in a glance. The Econoday Investors Journal is your essential desktop resource for economic events and indicators, FOMC meetings and announcements, US banking holidays, equity settlement dates, and more. The Econoday Investors Journal is much more than a financial calendar. It's an indispensable tool to help you anticipate active days in the market. Learn the intricacies and interactions of the market, record daily market activity, and explore helpful insights from experienced market analysts. Take advantage of our informative resource centre, which includes a comprehensive glossary of need-to-know terms, clear, concise information on policy and historical trends, useful graphs, and a guide to the influencing factors and people to watch at the Federal Reserve. Order your 2022 Econoday Investors Journal now at shop.econoday.com.